Economic event analysis is a common accounting principle that assets minus liabilities is equal to equity or net assets. Equity is broken into different elements such as share capital, reserves, which include retained earnings, and other reserves. Accounting transactions are exchanges of something of value between the accounting entity and another entity. This also includes transactions of owners. Some economic events, though not accounting transactions, still might be recorded in the accounting records, such as revaluations, increasing the value with any exchange taking place. Inventory write-down, maybe the inventory is obsolete but it would still have to be recorded at the value after impairment. We would use a conceptual framework to identify if an economic event has affected the accounting equation. Remember that the accounting equation must always balance. A simple format that we can follow is by counting down each accounting element in order and finding out the transactions that affect each account. First off, we begin with assets. Has your assets increased or decreased? Does the accounting equation balance? If yes, then you can stop and record. Otherwise, you continue to liabilities. Now you're on liabilities. Have liabilities increased or decreased? Does the accounting equation balance now? If yes, stop and record. If not, you continue to equity. In the extended accounting equation, you would also need to add income and expense. Here are 5 quick exercises you can do. Pause the screen and complete the equations and wait for the next slide to show the answers. List the accounting elements that would be affected and the direction if they would increase or decrease. It is important to note the significance of dividends. Dividends are not considered expenses. The economic resource is to the owners, not the business. Dividends would cause a cash decrease, but there is no obligation, so there would not be a liability. However, net assets would still decrease. This would mean that there is an owner distribution. Therefore, dividends are not an expense. Dividends would not even show in the statement of comprehensive income. Rather, they would show up on the changes in equity. What if dividends were postponed for payment to the future? There will be no payment or resource generation from upon declaration. This gives rise to present obligation and there will be a probable outflow of resources which will be measured reliably. Dividends payable increases and dividends would increase, causing equity to decrease. In our next lecture, we will be discussing the accounting statements.